Margins under pressure. Live from New York City this morning. Good morning, good morning. Your equity market is heading lower. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open with Jonathan Ferro.
Live from New York City, we begin with the big issue. Margins, we have a problem.
Today is a great example of consumers pushing back on higher prices. And
it's really impacting retail earnings right now.
They're saying you can't raise prices.
As people have a tighter labor markets, and yet if people are spending less,
the consumer balance sheet remains at a low level of leverage.
Global supply chains are under a lot of pressure.
The tail risks could be getting bigger here.
Markets are pricing in the fact that we are trying to destroy demand effectively.
We wanted to see demand cool off a bit to balance things, to bring inflation more under control.
So far, we haven't seen it.
It's sort of what we were hoping for, but also a little concerning on how much this raises the possibility of recession.
The window for soft landing is really getting narrower and narrower.
Joining us now to discuss Evercore's Julian, Emmanuel and Jay Pelosky of TPW Investment Management. Let's get straight to you, Julian. Just how many targets are out there?
Look, it's very clear that particularly when you're interfacing with the consumer in a labor-intensive industry, you're going to encounter these issues. But what we take away from this morning's reports and yesterday's is the glass half full aspect of it, and that is that the consumer remains strong. Yes, there are margin issues. Yes, they're going to be persistent, but no, the weakening that many have expected is really not materializing just yet.
So, Julian, how can you say that when Target's down 24.65% today and Walmart was down more than 10% yesterday?
That is, again, that stock price reaction in an environment where if you say anything wrong, whatever it is, and obviously margins and labor costs have been the key words to exert pressure on stocks, you're going to get that reaction. More importantly, John, is the idea that despite the fact we saw what we saw yesterday, despite the fact that Powell doubled down on hawkish rhetoric, the rest of the market traded okay.
We can build on that in just a moment. Here's the line from the CEO of Target. I think we're all surprised he's surprised. I felt like this yesterday with Walmart, and here's Target this morning. Throughout the quarter, we faced unexpectedly high costs, driven by a number of factors, resulting in profitability that came in well below our expectations and well below where we expect to operate over time. Jay, I want your view on this. Are you surprised that they're surprised by something we've been talking about for 12 months?
Well, it is a little bit disconcerting, right, John? Because certainly in the markets, we've been discussing this for some time. But it is, I think, as Julian mentioned, kind of idiosyncratic to certain companies, right? Other companies have done well and have managed better. And so you're actually, in my view, I'm not a stock picker, we focus on ETFs, but you're actually having an opportunity to differentiate between companies that are able to manage through this process and companies that aren't. And therefore, the market should reward the ones that do and penalize the ones that don't. And I think that's what we're seeing play out. On a broader picture, I would just note a couple of things. First, we've just gotten through earnings season, Q1 better than expected around the globe, US, Europe, Japan. Earnings revisions indicators actually turning up, according to JP Morgan, both in the US and Europe. And Ed Yardeni noted the other day that forward sales estimates for the S&P have risen 5% year to date. And so there's a reason, John, I think that the old saying is that stocks are a decent inflation hedge. And it's because they're able to pass through, to an extent, certain increases in prices. And I think that's what we've seen. Earnings are holding up well, and that for us anyway at TPW Advisory is one of the things that keeps us constructive.
Jay, which stocks, and I think that's the right point, and you started with that. Finding the right balance right now is clearly really, really difficult. We've gone from understaffed to overstaffed, undersupplied to oversupplied, and certain companies in certain industries have too much inventory. We're seeing that with Target, we're seeing it with Walmart, and arguably on the staff issue, we saw it with Amazon as well. So when you start to think about single names, which I know you can't speak to, Jay, you can do this at an industry level. You can think about the industries that are constrained, are being really, really strict, disciplined about capacity. And I think of energy and I think of the airlines. Now, Jay, how sustainable is the success that those two industry groups are having right now through the rest of this year?
Excellent question, John. I think you're right on it. Certainly in the commodity complex, we've been quite bullish. We've had a double overweight since last year on the view that they've been very focused on not increasing capacity. So as demand comes through, now they're able to use that capacity fully. Javier was just talking about the unprecedented refining margins in the energy space. And on the airline side, again, we've been very bullish. That's been our reopening play. We've been in JETS, which is the ETF there for, again, well over a year. And it's been pounded over the last couple of weeks because of jet fuel prices. But now, certainly the bigger point in my view, and we've talked about this before, is that the reopening from COVID is occurring pretty much everywhere outside of China. People do have money and they want to spend it and they want to travel. And so you do have opportunities throughout the cross asset, not just equities, but across the board, opportunities to be selective. I call it a golden age for asset allocation. And I think it really shows who has the chops and who doesn't.
Julian, let's talk about that. I had a question that I'd asked almost every single day last year. Who has the pricing power? Who has the pricing power? And the truth of the story was, when you're facing down a really strong positive demand shock, pretty much everyone had the pricing power. Now that question, Julian, gets a little harder, a little more difficult to answer. Who has the pricing power? Where'd you find it?
Well, again, and this goes back to our view, is something you and I have talked about in recent weeks, is that long-term, we think active management works. This is a market of identifying stock ideas. They exist. They exist across all industries. You know, not all consumer staples names are created equal. Same with industrials. You really have to dig down, and frankly, when you look at transcripts, management is telling you who has the pricing power and who has margin pressures. And lo and behold, the stocks that have had positive commentary have outperformed consistently over the first half of this year, and we think that's likely to happen through the second half of the year.
Well, Target right now are telling us we have a margin problem. They're down 24% in the pre-market. Equity futures are lower off the back of that story that developed a couple of hours ago. Equity futures on the S&P and the NASDAQ down across the board here. Futures down by more than 1%. Then you've got to throw in the Fed and Chairman Powell. Take a listen to this.
What we need to see is inflation coming down in a clear and convincing way, and we're going to keep pushing until we see that. If that involves moving past, broadly understood levels of neutral, we won't hesitate at all to do that. We won't.
Joining us now, Kelly Lyons. Hey, Kelly.
Hey, John. Well, they always say don't fight the Fed. Jerome Powell's message yesterday was do not doubt the Fed either. Do not question the Fed's resolve to fight inflation, even if that means ultimately getting restrictive when it comes to interest rates. So obviously the market trying to digest this. Stocks were actually higher in the face of his remarks yesterday, but futures lower now, and a little bit of movement upward in yields at the front end of the curve, up 2 basis points on the 2-year to 272, even in the face of what some called the most hawkish remarks from Chairman Powell to date, raising a question of why the market reaction maybe wasn't more so dramatic. The thing is, the hawkishness didn't come in the form of ideas of potentially larger rate hikes. It's really just a question of where the Fed is ultimately going to get to as it fights inflation running at hotter than 8% on CPI and policy. Clearly, that is running very far behind the curve. Of course, we also heard from Jim Bullard of the St. Louis Fed yesterday, who said 50 basis point hikes at the coming meetings is a good plan, while Charlie Evans of the Chicago Fed also spoke yesterday, and he said he expects the Fed will have slowed its pace to 25 basis point increments before December. As for what the market is pricing, another 200 basis points higher on the Fed funds rate through the remainder of this year. And it's worth noting those hawkish expectations don't stop here in the U.S. The market also sees 127 bips from the BOE, 111 from the ECB, which hasn't even actually lifted off yet. And of course, we are going to get more Fed speak throughout the coming week. You have Philly Fed's Patrick Harker later today. Then you have Kashkari of the Minneapolis Fed tomorrow. And then a week from today, John, the minutes from the May meeting. What clues will those minutes hold, John?
We can't wait. Kelly, thank you, as always, for the Fed speak through the week and into next week as well. I want to go to a quote from Goldman Sachs and start thinking about the difference between a 3-month view and a 12-month view. This is what Goldman had to say. We downgrade equities to neutral for 3 months. They remain overweight for 12. The stagflationary macro momentum means multi-asset portfolios are likely to remain volatile, with both equities and bonds vulnerable. We remain overweight cash. That's Christian Muller-Glissman there, leading that coverage. Jay, I want to explore an idea with you that's developing at the moment. A 3-month view. This is the idea. There are some people who believe that this Federal Reserve wants to see a further tightening of financial conditions. and any rally in the equity market would be perceived as an unwarranted loosening of financial conditions that they would have to push back against. Now, I want to understand from your perspective whether that puts a lid on risk assets and equities more specifically as we work our way through this summer.
I think that's an interesting question. I mean, Goldman Sachs has been splitting hairs both on their targets for prices, stock prices, as well as growth here these last couple of weeks, going back and forth. But your question's a good one. I think over the next couple of months, what we're likely to see is declining inflation, significant declines of inflation over the next couple of months, as well as stable growth. I mean, the market, as I see it, is divided into two camps. One who believes inflation is out of control, Deutsche Bank and others. The second who are very worried about recession. And I think there's a middle path. There's a middle path where inflation comes down, growth is okay, and we take that 3-month view, extend it into year end, inflation around 4%, growth between 2.5% and 3%, nominal growth of 7%. And we've talked about this, John. I think people are not understanding that nominal growth of 7% or so is double nominal growth rates that existed pre-COVID in the 5 years between 15 and 19. And so earnings estimates are going to be easy to beat, and that is going to support equities. Whether the Fed acts as a cap, I take it from yesterday that the market has priced in an aggressive Fed. And the fact that the 2-year peaked several weeks ago, bonds have rallied in the midst of the inflation numbers over the last couple of months. I think the inflation issue is priced in. A hawkish Fed is priced in. The growth question, I think that's where people, smart folks who I'm talking to, that's the concern that's starting to grow.
Julian, do you agree? A 2-year right now, 272, highs 285, 10-year just short of 3, the highs 320. Your view?
So if you think of all the noise of the last week or so, particularly, again, Powell's comments yesterday, and you look at the fact that yields basically backed off that high at 320 in the 10-year and have been, reasonably calm given the volatility, I think you can argue that the market is actually comfortable, number one, where the Fed is and how it's thinking. But also, we don't believe that the Fed is specifically targeting stock prices in any way, because the issue there is, John, it doesn't happen all the time, but the linkage over the last 40 years between tops in markets and bear markets and the onset of recession, and the Fed does not want a recession in our view, that linkage is far too robust to specifically target stock prices.
Julian, I'll put it a different way. We used to talk about the bond market and any sell-off there being self-limiting. The yields would rise too much, they'd eat into the economy, the Fed has to back away, yields have to back away too. There is just a belief now, and I understand that you don't share it, that some people believe that any rally in risk assets is self-limiting because it's a rally this Fed would have to push back against this summer. Do you disagree with that?
We do, because, again, and the chair's commentary is a comfort with tightening financial conditions. However, if the inflation numbers started to come down to a level that made them significantly comfortable, and again, this is a process. We're still looking for 3% on core PCE next year, and I think most of the street is as well. So it is a process. But if inflation started to come down without more tightening in financial conditions, I think that's an environment the Fed could live with.
Julian? You're going to live with us too. You're going to stay with us at least for the next 20, 30 minutes. Jay Pelosky too. Let's get you a look at some of the stocks ahead of the opening bell, 17 minutes away. Here's Abby.
John, well, we have to start with the one you've been talking about all morning, and that, of course, is Target, right now down more than 24%. I've gone through the price action by hand, and it looks like Target is heading to its worst day since October 19th, 1987. So very similar to Walmart, a similar story. Rising costs really pressuring operating margins, in this case by 200 bips, light on rising costs. And the degree of these stock declines for both Target and Walmart yesterday shows just how off guard the street is caught by this. Similar, it sounds like, to CEO Brian Cornell. And it seems that big box retailers finally unable to manage rising costs and inflation, a topic that we've been talking about for months. Lowe's down 3.3%, a small sales miss there, weather being blamed on the slowdown. That obviously was not the story for Home Depot. Netflix down 1.9%, a representative of mega cap tech. down. I don't know how mega cap Netflix is at this point. Plus, they did fire people yesterday. And then Twitter, a brief reprieve yesterday from the selling, but there still is no deal with Elon Musk. That stock down, once again, down 0.8%.
Abby, thank you. As always, coming up, a geopolitical turmoil raising the cost of living around the world.
A sequence of shocks like this, which have really come one after another with no gaps between them, is almost unprecedented.
That conversation up next.
We should all aspire to encouraging China to drop objectionable practices. If we can do so, we will stand a better chance of competing with China on a level playing field, which will benefit our businesses and consumers.
Secretary Yellen talking about a range of issues, China being one, Russia being another. Front and center, though, right now, the price pressure that consumers face in the United States of America. This was Brian Deese of the National Economic Council. Take a listen.
The reason why we have that challenge is Putin's decision to invade Ukraine and the implications of taking Russian supply of crude oil and natural gas, but also of Russian refinery capacity off of the global market. Refinery capacity was tight prior to the invasion, but the real stress that we're seeing on refinery capacity right now is a direct result of the war in Ukraine and the impacts on energy markets.
Joining us now, two friends of mine, two friends of this show. Anne-Marie Hordern, down in DC, from London. Guy Johnson, AMH, first to you. Gas prices, that's the big issue.
Yeah, it is. And this morning we have another record. They're above $4.50 on the average. And you look at some counties across America, one in California particularly, is looking at higher than $7 per a gallon of gasoline. And Jonathan, we should note, we are not even at the start of peak driving season. So gasoline prices is one big problem for the administration. You also have, as recently, earlier this month, the agricultural department talking about the fact that food prices will rise 5 to 6%. And then on top of all of this, not so much an inflation story, but also really hitting families, Jonathan, that have young ones, this infant formula shortage. And in a week's time, we're going to hear from some of these executives because Congress wants to get to the bottom of why families are facing this. So a number of issues dealing with everyday Americans' kitchen table, whether or not they're feeding their families or filling up their gasoline pump. And this is really impacting some of the hurdles the administration is facing as we are heading towards November midterm elections.
A guy at that kitchen table in the UK right now, there's one number that will dominate that conversation later this evening, 9%.
It's amazing. John, we haven't had inflation this high since 1982. Thatcher was in control then. She was trying to supply side reform the economy. We haven't had inflation this high, and it's going to get worse. John, everybody is pointing the finger at everybody else, trying to blame them for what is happening here. We had it from the Chancellor yesterday. This is international. This is rising energy costs. The Governor of the Bank of England saying similar things. We're going to hear from the Chancellor again tonight. Everybody is pointing the finger at somebody else. But ultimately, central banks have missed this. Governments have missed this. Hey, if Target and Walmart miss this, you've got to worry about central banks' ability to be able to manage the situation as well. John, we are way off base. 6 months ago, the Bank of England was predicting that inflation right now would be half the level that we have now. We're heading for double digits. It's going to get worse from here. And as Anne-Marie was pointing out, it is very regressive.
Guy, I'm really looking forward to the coverage in about 40 minutes with you and Alex Steele. Thank you, buddy. To you as well, AMH. Here's something a politician won't tell you. This note from JP Morgan on gas prices. Right now, the average gas price in America about $4.60. JP Morgan say this: a cruel summer with US gasoline prices breaking above $6. Typically, refiners produce more gasoline ahead of the summer road trip season by building up inventories. But this year, since mid-April, inventories have fallen counter-seasonally. Julian and Emmanuel, Jay Pelosky with us for a final word. Jay, if that developed, would you have to change your view?
No, I don't think so, John. I mean, one of the things that we need to keep in mind is that the amount of money people spend on food and fuel relative to, decades past is much smaller than it used to be, and it's risen somewhat, but it's still not anywhere close to previous peaks, either on a per capita or GDP basis. And I think there's going to be, I'm actually getting constructive on the outlook for energy prices, because I think in Europe, there's kind of been a little bit of a deal between the EU not pushing to eliminate completely and immediately Russian sources. I think because they feel that Ukraine is doing well enough on the battlefield that they're not going to get the pressure of being told that they're funding Putin's war machine. And at the same time, Russia clearly needs to be able to continue to sell their energy where they can. And so you saw that chart on the natural gas in Europe. While all this talk is going on, natural gas prices in Europe are down about 50% from their previous high earlier in May. Brent is down, $20 from its high of 135 early in March. And so to me, again, I think, yes, prices at the pump, they make a good story. They're politically toxic. But from an equity investment or a global cross-asset investment basis, I don't think that's the big picture. I think the big picture, arguably, is that we're settling into a higher price point in energy that's probably going to be sustainable, but it's not going to be super volatile as it has been the last 6 months.
Julian, Jay took all your time. You've got 30 seconds, buddy. Final word.
We actually would place a little bit more importance on the gasoline price. The psychology of the consumer, even though they're spending, that we know, the psychology remains fragile. And to us, if you get a further spike higher, I don't know what that number is. If the average price is $4.50 now, probably $5.50 is sort of a yellow flag. That could tip us toward a slowdown. We will be watching it very carefully this
Julian,
summer.
thank you, mate. Perfect timing too. Julian, Emmanuel, Jay Pelosky, to both of you, thank you. Coming up, the morning calls, and later, Wall Street finding some comfort in hedging amid surging volatility. That conversation with Lori Calvasina just around the corner. Equity futures are negative here. Here are your morning calls. First up, Bernstein upgrading Monster Beverage to outperform, expecting growth to re-accelerate over the next few quarters. Your second call from Guggenheim cutting its meta price target to 250, forecasting weaker revenue growth amid increasing competition. And finally, Truist downgrading Target to a hold, expecting shares to remain under pressure after cutting its profit outlook. We're down there by almost 25%. Coming up next, Lori Calvasina saying valuations are no longer the problem. The opening bell just around the corner. Look out below for some of these retail names. We're about 20 seconds away from the opening bell, and we are negative by more than 1% on S&P 500 futures. Target is about to get absolutely hammered. On NASDAQ futures, we're down by 1.5%. From New York City, for our audience worldwide, the opening bell rings in New York. Switch at the board and get to the bond market. Yields just a little bit lower, by about a basis point to 297.87. In the FX market, the euro just a little bit stronger. Euro dollar negative a third of 1%. The dollar stronger at 105.19. And outside of that story in the commodity market, up about 1% on crude, 113.53. A lot to look at around the open. Let's get to Abby for more. Hey, Abby.
Hey, John. Well, indeed, a very brutal day for Target, the worst since October 19th of 1987, absolutely plunging down more than 24% at this point on a massive operating miss. Walmart down for a second day in a row. Similar story there, rising inflation costs, these companies not able to manage this finally. So for the quarter, Target's operating margin of 5.3% coming in way light of 9.5%. The full year guide taken down to by 2% to 6% from 8%. Massive, massive miss, and that stock absolutely getting punished. TJX companies, though, on the other hand, a bright spot, up 8.9%. Interestingly, they missed sales slightly, but their profit outlook held. They actually raised it by 20 basis points. So again, a bright spot. Yesterday's bright spot, though, John, big tech, really not happening today, down 1.4%. That is the big anchor yesterday for stocks. Today, it's dragging in the wrong way.
Just looking at that, the same thing. Abby, thank you. We're down about 1.2% on the S&P 500. Outperformance on utilities up by 0.2%. As Abby just pointed out, information technology down by 1.4%. Consumer discretionary down by 2.9%. Twitter all over the place once again, as we often do now. Let's get to the West Coast and catch up with Ed Ludlow. Hey, Ed.
Good morning, John. We're down around 1% on Twitter stock, trading $37.94 as it stands. The latest development, the board of the company issuing a statement to Bloomberg saying that they are committed to the deal at its original terms. Elon Musk offer of $54.20 a share, valuing the company at $44 billion, and they reiterate that they recommend to shareholders that they go with that deal. You look at the spread, and you come into my Bloomberg terminal, the spread on this deal is wide. We track this because it gives us an indication of the probability Wall Street assigns to the deal going through. But as you know, John, looking at this stock now down 0.9%, we've reversed the direction that we were going on Tuesday, where we saw gains. Bloomberg also reporting on Tuesday, John, that 3 high-level managers have left the company. And a last interesting one, I'm just looking at the Bloomberg, only 8 out of the 37 analysts covering this stock have raised their price targets to $54.20.
Ed?
Another indication of what we feel about it.
Got to leave it there at 38, 37.96 for a moment. Now about 38. Ed, thank you, buddy. A couple of moving parts today. We'll stay on top of the stories for you. We've got Target down about 22% at the moment, and a headline from Secretary Yellen out several minutes ago. Back to D.C. now. Let's catch up with Anne-Marie. AMH, what have you got?
Well, what we're hearing from Secretary Yellen is that, Jonathan, there's no final decision yet, but this license on Russia and their ability to pay debt, likely, potentially, that could end. And if this is true, what Secretary Yellen is saying, and it confirms a Bloomberg scoop by Saleha Mohsin yesterday, saying that the Treasury Department was leaning towards this. There's basically been a carve-out. They've been allowing Russia to pay their debt in dollars. And what they potentially are going to do now is not allow that to lapse. So that would end, and it means that Russia at this point would be in a very difficult position. They owe about $500 million on these debts towards the end of June, though some of it potentially could be paid not in U.S. dollars. Yesterday, we heard from the Russian finance minister saying that they will pay their debts and they can pay them in rubles. But, Jonathan, it's that very gray line right now. Potentially, Russia is ever so close to getting in default. They have a will to pay, but without this carve-out, it's going to make it very difficult.
A very unique situation. AMH down in D.C. Anne-Marie, thank you. Looking forward to your coverage on this story through the day. Back to the retail story around the opening bell. We're about 3 or 4 minutes in. Yesterday, it was Walmart. You've got a second day of it. Today, it's Target. That stock is down by 23%, cutting the outlook for profit. Things do not look great for that name at all. Katie Lyons back with us for more. Hey, Kaylee.
Things look brutal, in fact, John. Target potentially heading for its worst day since 1987, just like we saw Walmart posting its worst day since 1987 yesterday on the back of its own outlook cut. But one analyst over at Vital Knowledge saying that this is just more dramatic coming from Target as they cut their operating profit growth forecast for the year to 6% on that margin. They previously saw 8% or higher. The problem isn't really with sales, John. It's actually just converting those sales into profit. Traffic in the first quarter was actually up nearly 4%, but the average transaction total was down by 0.6%, in part because Target took heavy markdowns on items in order to start getting down inventories, which had built up 43% higher than a year ago at the same time that demand has receded for some of those bigger items. So the point is, while there are more shoppers, they are buying and spending less, and it's also a matter of the mix, what they are spending on. Target essentially dealing with the exact same forces Walmart detailed yesterday. Food and gas inflation is drawing money away from discretionary general merchandise spending that is typically higher margin. And when you cater to a lower end consumer, it limits your ability to exercise pricing power and raise costs to offset the higher costs on supply chain and labor issues that you are facing. And it's not like things are going to get a whole lot better anytime soon. Target CEO saying, looking ahead, it is clear that many of these cost pressures will persist in the near term. So that's bad news for Target. But what warning does that send for corporate America more broadly, John?
Kelly Lyons, thank you. It's a question we're all trying to get our hands around. We've been talking about this for a year. Yet the C-suite somehow surprised by something they shouldn't be surprised by in the first quarter. If we spent 12 months discussing it, how is it a surprise in the first quarter? That name is getting absolutely hammered, down about 24%. Outside of that, in the bond market, not much going on here. Your 10-year yield down about a basis point to 298. Your 2-year yield up about a basis point or two to 272. We've come down from 285 to the 270s on twos, down from 320 2 Mondays ago on a 10-year to about 298, just short of 3% right now. In the equity market, we pulled back by 1.24%, just to give you the sector breakdown. Consumer discretionary down by 3 percentage points. do the guesswork as to what's driving that. Consumer staples down by 1.8%. Utilities, that's where you get a little bit of outperformance, where you get a little bit of green. We're positive there by about 0.1%. RBC's Laurie Calvasina trying to keep it simple, saying the following. The S&P 500 is currently at an important crossroads. If 3850 does not hold, we think the equity market will be telling us that it's starting to price in a recession. I'm pleased to say that Laurie joins us now. Laurie, let's go there. What are we pricing in?
We're pricing in a growth scare. We're pricing in a near-death experience where everyone frets, worries very deeply and legitimately about the end of the cycle. We've seen a number of these episodes before. If you go back to the financial crisis, there have really been 4 different ones: 2010, 2011, 2015, 2016. Remember, that was the industrial earnings recession, which did not result in an economic recession. And then we also had the late 2018 debacle where we had quantitative tightening from the Fed, a lack of faith from the Fed, and fear that China and the trade war was going to pull us into a recession. And those drops all saw 15 to 20% drawdowns in the market. We've gotten very close to that 20% threshold, sort of the outer bound of growth scare territory. And I think the market is, it's trying to find a bottom in here. There's a lot of uncertainty in this market right now about whether or not that recession is going to come through or if it's going to be another near-death experience. And I think that's why it's trying to bottom, why it hasn't broken, farther. We hit 3860 intraday on Thursday. I think that was a very important tell. And I think the market is frankly, like the rest of us, trying to figure out what that next step is economically.
Laurie, you compared it to 2010, 11, 15, 16, 18 as well. You went through the performance over those periods. Talk to me about the valuation, the kind of numbers that we had to drop to before the buying really started to rebound in a major way.
It does feel like when you look at multiples that they tend to bottom out in very different places in very different cycles. I'll tell you from a multiple perspective, what we found to be the most useful exercise is to go back and look at past Fed tightening periods. And what we found is that you sort of at your outer bounds, you tend to see 20, 21% type PE contractions. We've also seen several instances of 17% multiple contractions. And I think what that's telling us is that the Fed itself is priced in. Now, if you go and look back at, sort of past recessions, they're a little bit all over the place. We saw a 20% multiple contraction around the 90-91 recession. If you look around the financial crisis and the tech bubble, those were obviously much, much deeper. The pandemic was also much deeper. I think it was in the 40s. So I think that, we sort of look at the multiple contraction we've had so far. It's been a little better than 20%. It's right in line with kind of those past Fed, kind of extreme tightening periods that didn't necessarily end up with a recession. And so I think that's what the market is pricing in from a Fed perspective, this big, huge, nasty, aggressive Fed that's going to tighten things in a hurry, that's going to slam on the brakes, but it's not going to that next step yet from a multiple perspective and pricing in a recession. The problem when you're assessing multiples, John, is you have to figure out what kind of recession is it going to be? Yep. Is it going to be a milder one like 90-91? Well, that one was only about a 20% contraction. That's pretty much in already. But if it's something nastier, there's probably a longer way to go. I'm personally in the camp that we're not going to have a recession. And if we have one, it's going to be short and mild. But if we're wrong, there is substantial downside.
Laurie, talking about the price of the story, a question I hear a lot of is whether we've seen capitulation, whether investors have actually capitulated on some of this. And there are ways of measuring sentiment. You offer 3. The VIX, the equity put call ratio, as well as crypto. Can you walk me through those 3 issues right now, those 3 gauges, and tell me whether you've seen sufficient capitulation?
Sure. And we also look at the CFTC data and the AAII net bull bear. And so, look, I'll say if you put sort of VIX and equity put call together, they're elevated, but they haven't, sort of seen the worst spikes that we've seen even around some of these growth scare periods. We've talked to our desk about that, and we think in part that's because the unwind has been somewhat orderly. People have been able to get hedged. So we're not necessarily sure we're going to see a washout there, but I think it's fair to say those may need to move a little bit more to fully have some institutional capitulation. If you look at crypto, a lot of discussion about what crypto means for the U.S. equity market, and I do not pretend to be an expert there. But what I will tell you is that we do see a correlation between stock prices and Bitcoin. And if you look in the past, Bitcoin has been a bit of a leading indicator for helping you get out of stocks. Unfortunately, at the bottom, they're pretty much coincidence. So I don't think you can really look at crypto to get you that lead, to get you back in the market at this point in time. It was really giving us a sign at the peak. It's not really telling us too much now, but there, of course, has been severe declines there. I will tell you, equities don't tend to go down as much as crypto. So it does end up being sort of a safer asset. Now, if you look back at the AAII and CFTC, I think AAII is telling you that, sort of high net worth retail has capitulated. We can go into more detail there if you want. And on the CFTC, the institutions are getting very, very close. They may have already.
Well, stocks are down hard again today by 1.5% on the S&P, and one particular name is down even harder. It's Target by 25.6%. Laurie, I'd love your view on this, and I know you can't offer me some specific single name advice, but I'm trying to understand whether we really haven't priced the earnings story just yet. I just saw that name this morning come out with those earnings. I saw it happen with Walmart yesterday. The C-suite sounding surprised, the market, clearly analysts, very surprised by the outcome on a story that is so well understood, yet apparently in certain parts of this market, very poorly priced. Laurie, what does that tell you?
So I think you have to divide different parts of the market and sort of talk about trends that you're seeing there. You know, I think that we're in a very strange point from an earnings perspective in this market right now, because cyclicals, frankly, are just not as important to S&P 500 earnings as they were back even in the 2015-2016 industrial earnings recession. And I'll give you the market cap stats, but back then, right around that kind of mid-2015 period, cyclical sectors and secular growth sectors were both about a third of the market cap of the index. And what we've seen in more recent trading is that secular growth is about 50% of the market cap, and cyclicals have been down closer to around 25%. So we know that, you know, the cyclicals just are not as important drivers as they've been in the past. And if you look at secular growth margins, those are the ones that have been up and to the right, which is why they have that market cap share. My point here, John, is that, you know, I think with individual names, some of these retailers in particular, some of them, frankly, had not been taking as much pricing in the past as they could have. So there were some missteps in the past. But I do think that there are specific names that are having trouble. Clearly, the worst case scenarios were not priced in, the risks were not priced in. But when we think about it from the market, you can't overly, you know, just sort of focus on a particular sector, a particular industry, especially if it's in that cyclical part of the market, because things like software companies are just so much more informative these days of S&P 500 margin trends and earnings trends. And they're really buffering them and boosting them in a way they weren't even 5, 6, 7 years ago.
Laurie, that final point is a very important one. Laurie, you're one of the best. It's great to catch up with you. What a complicated time. Laurie Calvasina there of RBC, and what a difficult moment in this market again. 13 minutes in, down 1.6% on the S&P. On the Nasdaq, down by almost 2 full percentage points. Coming up, Twitter saying it's not letting go of the deal at Elon Musk's price.
If a deal does get done, it's significantly lower than the 54.20. I mean, 54.20 at this point, it's out the window.
Right now, there is a monster spread between where the stock is and where that offer price was agreed. That conversation up next.
If a deal does get done, it's significantly lower than the 54.20. I mean, 54.20 at this point, it's out the window. There's a better chance for me playing for the Celtics in the playoffs, and that deal happened at that price. Now it just comes down to, can they renegotiate on the bot issue, or does he walk?
Dan Ives always has a sporting reference, doesn't he, for pretty much everything, including this story right here. There is an agreed price, it's 54.20, and the board says the following. The Twitter board, in a statement to Bloomberg, we intend to close the transaction and enforce the merger agreement. Ed Ludlow has more on the West Coast. Hey, Ed.
Yeah. Good morning, John. So we're trading down 0.6%, around $38 a share, pretty distant from the $54.20 per share offer that Elon Musk has in. We talked about the spread, right? The gap between those prices as being an indicator of how Wall Street assesses this deal. But there's also a spread between what's happening in public and what's happening behind closed doors. Fantastic reporting on the Bloomberg terminal from our deals team colleagues, who basically explain, according to sources, that Elon Musk's advisors and bankers are just carrying on as normal. Behind the scenes and in private, the negotiations are happening as if this deal was going smoothly. One key piece of reporting that we cannot emphasize enough: the proxy filing of Tuesday was signed off by Elon Musk, according to sources. The proxy filing on Tuesday advised shareholders to vote for a deal at $54.20 a share. So there's this gap, right? The tweets that we all follow from Elon Musk and what his bankers and advisors are doing in the background. But Wall Street's not convinced. Any indicator we have from the market is that there is a lower probability of this deal happening at all. And if it does, probably coming in at a lower price point.
And the price of the stock is doing the talking. 37.83. Right. The agreed price 54.20. That's a big spread. Ed, thank you. I have no idea what happens with this deal. I can guarantee you one thing. Lawyers and bankers will make a lot of money. Shonali Basak has more. Hey, Shonali.
Hey, John, you have more than $100 million worth of deal fees that are associated with the Twitter deal for Goldman Sachs and JP Morgan. Some of that has come up front. Remember, Goldman and JP Morgan did the fairness opinions as well when it came to this Twitter deal. And when you look at the filings, actually what's so interesting is the idea of a lower deal price. Based on precedent transactions, neither bank goes below $50. According to the Financial Times reporting this morning that pointed a lot of this out, it would get very hard to get much lower than that. And most of the deal fees, in fact, as most deals, come after the deal closes. So that's an $80 million payout that would come for Goldman Sachs, $53 million for JP Morgan. As we know, Morgan Stanley is advising Elon Musk separately, so there are more fees on that side as well. But remember, based on those fairness opinions, it will be very interesting to see what that new deal price would be if you ever got one. And also, you know, I have to point out Bloomberg Intelligence is reporting here legally how much Elon Musk might be tied to this deal regardless of that breakup fee. BI saying a 60% probability here that if this did go to court, that they would still have to consummate the deal.
Shonali, just quickly, separate story. You mentioned Goldman. You caught up with the CEO, David Solomon. What did he have to say?
Yeah, what's interesting is David Solomon has been hitting the nail on the head for a long time here on inflation. I go back to October when I talked to him, and he said it was forefront of every conversation he had with investors. Now he's saying that it's extremely punitive. While he hopes we don't get into a recession, he certainly sees the risk of it. He says clients are preparing for lower asset prices, tighter monetary conditions. The thing to watch here, he says, is credit spreads. We're not seeing that trouble yet, but that would be the one thing he is watching for, John.
That story out on the Bloomberg terminal and on Bloomberg.com right now. Shonali, thank you. From New York City, that does it for me. Up next on the program, Mike McKee is going to be sitting down with a Fed official that you need to listen to. That's going to be next on this program. From New York City, this was the Countdown to the Open. This is Bloomberg.
Hello, I'm Bloomberg's Michael McKee, live on TV and Bloomberg Radio worldwide with a special guest. Chicago Fed President Charles Evans is joining us now. And Charlie, thanks for coming in. It's nice to see somebody in person for a change.
Good morning, Mike. It's good to be here.
A lot of people questioning now whether the Fed is going to be debating monetary policy or whether we're kind of locked in for the rest of the year. The Fed has said, and Jay Powell has said, 50 basis points at the next couple of meetings. Would you anticipate something like that running through December?
Well, you know, we've been discussing the state of the economy and inflationary pressures for quite some time, and the committee has definitely coalesced around you know, moving off the effective lower bound. We've already, you know, begun doing that. And as Chair Powell said, we're going to be moving expeditiously towards something much more like a neutral Fed funds rate. My own assessment of neutral is in the 2.25% to 2.5% range for the federal funds rate. You know, as the chair has said, you know, we just did 50 and, you know, 50s are on the table for some period of time. I would expect by the end of this year, it could be quite likely that we were at a neutral setting, and I think we would be very well positioned to address the you know, future inflationary pressures of 2023. I'm expecting things to improve from the very high inflation that we're having, but I do think that it's going to take us some time to take care of this.
Do you see any probability or possibility or reason that a 75 basis point move would come to the table?
Well, I think it's very useful to front load our policy settings at the moment. We did 50 at our last meeting, and it's extremely likely that 50 at the next meeting and, you know, probably thereafter. You know, it's once we get to a good setting for the funds rate when we can sort of after that do a more measured pace of increases, say 25 basis points at each meeting after that. I think that would be a nice shallow path that would give us time to assess the incoming data and know exactly what we're facing. So if we do a little bit more sooner, then we can get to that point where we can do the shallow path, or, you know, maybe we take 50s a little bit longer. But, you know, like I say, I think something like neutral by the end of the year, whether or not you know, get there sooner or, you know, earlier is not that critical. It's being well positioned to address the problems that we expect to face in 2023. That's my first concern.
How far above neutral do you think you may have to go to get the results you want?
It's a hard question. You know, Nobody reports what the neutral setting of the Fed funds rate is. It moves around over time. It depends on whether or not we've got tailwinds or at our back or headwinds that we're facing. And so I think we're going to be feeling our way around that. Like I say, I've got a benchmark of what I think. And so if we go beyond that, if we go 50 basis points beyond that, 75 basis points beyond that, then that restrictive setting of policy should be working to bring inflation down. We don't have to constantly increase the funds rate to be restrictive. We can get to a restrictive setting and sit there for a while. Maybe we sit there longer at a less restrictive setting, and it takes a little bit longer for inflation to come down. But there are many special factors that have led to the very, very high inflation rate that we're facing. And so I'm hopeful that in 2023, we're going to be facing core PCE under 3%.
Wall Street would like to know whether, if the economy slows, you're willing to slow the pace of rate increases to try to keep the economy from falling down, to keep us out of recession, or whether you will continue to be aggressive if inflation remains high. And I suppose that begs the question of whether you see a recession or not. So I'll leave those two questions for you.
Right. Well, we have a dual mandate. We are trying to set the monetary and financial conditions to support maximum employment and price stability. At the moment, the price stability objective is the one that's most critical because, at 8.3%, CPI, that's much too high. I think it's going to be coming down. The labor market is doing extremely well. There's tremendous demand for workers, and I'm hopeful that labor force participation will increase. But basically, we have a vibrant labor market. So the first order of business is getting inflation under control. Now, as we get to a restrictive setting of monetary policy, I do expect that the economy is going to cool a little bit. By cooling, I mean we're still going to be having growth. I think the growth at trend levels, 1 3/4 to 2. Trend is 1 3/4, but I'm looking for 2.2% as we continue to have a neutral to restrictive setting. And so that's consistent with growth. If we see something that's weaker than that, we'll have to see what that means for inflation. If inflation, the trajectory looks like it's confidently coming down and we're going to hit our 2% objective or be close enough to it, then we'd have a little more latitude. But at the moment, we really need to be focusing on inflation.
What's your forecast for inflation over the next quarters and year? And I ask that in the context of what you're hearing from the CEOs in your district about whether they're still feeling price pressures, whether they still feel they have pricing power.
Right. So when I talk to businesses, C-suite individuals or small businesses, they're facing a lot of cost pressures, and to the extent that they've been able to do it, they have passed along many of those cost pressures. I think the days of how long they're going to be able to pass that along are probably numbered. I think consumers are getting fed up with high prices, and they can respond by shifting their expenditures. But businesses are facing those pressures. They've raised wages, and in many cases where 6 months, 9 months ago, we heard that there were intense wage pressures. When wages have gone up, that has actually satisfied and improved the labor setting in those manufacturing plants. And so, higher wages, it doesn't necessarily mean they have to keep going up each quarter, each month. And so I feel confident that businesses are going to get on top of their labor costs, and pricing behavior will be more in line with, what I think price stability is. I can't reel off what inflation is going to be 3 months from now or 6 months from now, because there are a lot of real factors that could play out in different ways, and that's part of what we're going to be looking for. If we get to a neutral setting by the end of this year, we're going to have many more months of data to see, is the trajectory coming down, or do we still have a real problem on our hands and we need to be much more restrictive?
We are talking with Chicago Fed President Charles Evans. Let me follow that up with a question not from me, the professional economist, markets watcher, but from the average American. When am I going to feel like my paycheck is keeping up with inflation?
Yeah, I mean, it's been very difficult for households, obviously. Gas prices have been extremely high. Food prices are high. I think worldwide factors are an enormous part of that. Energy supplies, the Russian invasion of Ukraine is hitting, gas prices, agricultural prices. A lot of wheat is produced in Ukraine, and that has global implications and all of that. We have very strong demand, so it's it makes sense. It's what everybody's dealing with, higher prices, shortages. You can't necessarily get exactly the product that you want, and it's a lot higher. I'm hopeful that as inflation comes down, hopefully some of those prices will revert and they'll come down. Food prices often, can round trip, and energy prices too. But gas prices are high, and that's always, a negative thing for consumer confidence if we can get that in better shape. But that's not monetary policy, that's sort of supply conditions. And wages have gone up, so I think incomes have gone up, and the labor market is good. People who want a job can get a job. That's good for household income. If we can get labor force participation up and some child care to adult care issues resolved, keep everybody in schools, that'll be beneficial for the economy.
Have you been surprised by the strength of ongoing consumer spending, that people are still buying a lot of stuff, basically?
It has been strong, hasn't it? And, some of that, I think, is the fiscal support was very helpful for many households that otherwise would be in very difficult situations. I think that, the growth of the economy, many people are doing extremely well, even if it's unequally shared. And so sometimes those retail sales, come from sort of a skewed distribution of, consumers. And so it's nice that the fiscal support packages and the strong labor market, which has helped lower income workers, get jobs at better wages and also at better schedules, probably more full-time. I mean, that's been beneficial. And so I think that's contributed to the strength in retail, and I hope that it continues.
When you think about going forward, how much confidence do you have in your ability to bring inflation down, given that you've mentioned COVID and Ukraine and all of the other things that are going on that are supply side problems, and the Fed works on the demand side?
Oh, that's right. That's right. I mean, at one level, I'm extremely confident that we can bring inflation down. Inflation is the, ever increasing prices of all goods. And, that's a monetary phenomenon, and the setting of the federal funds rate, the policy rate, can address that. What I'm not confident about is we can't bring down gas prices. If gas prices are going to be very high because of real factors, low inflation is going to be, well, they're high, but they're not continuing to go up. But those are real factors, and it's another set of public policies that need to deal with that. Food prices are the same way. I'm confident that the setting of monetary policy can keep them from ever increasing. They could stay high on a relative basis compared to other prices for longer than most people would like, but we can get inflation down. It probably would take a more restrictive setting of monetary policy if those special factors continue to be high.
Before we let you go, let me ask you about the balance sheet, because that's the other side of your monetary policy that has to play out. What do you anticipate happening when you start lowering the balance sheet? Should we see a rise in interest rates at the long end because it was designed to push them down at the long end? And if so, by how much?
That's right. So we've increased our balance sheet dramatically, and we've announced that we're going to let maturing assets roll off. We chose among the most aggressive roll-off paths that we could. So I think we're going to get our balance sheet down to a more normal level before very long. That will have a restrictive effect on financial markets that sometimes is measured, I think, for what we're looking at. It's the same as if we'd increased the federal funds rate by 50 basis points on top of what we're actually doing. So we do have that restrictive setting. I tend to think that markets are forward-looking. They are, and they price this in pretty much when they know what it is. So I think that effect is already working its way through financial markets, and we've seen long rates go up some. We've seen borrowing rates, auto rates, mortgage rates go up. And so I think it's having that effect. That's helped somewhat with the front loading of restrictive monetary policies. And so that's, we're probably better positioned to be bringing inflation down because of that. So, I think that's working pretty much as we were hoping.
Well, we wish you luck. Thank you very much, Charles Evans, for joining us today, the president of the Chicago Federal Reserve Bank. This is Bloomberg.